Hello and good morning, everyone. Thank you for joining Blackfinch's 10-minute market forecast. My name is Josh, and I'm the product specialist for our listed investment solutions. And I'm joined today by Alex Sumner, who's Commercial Investment Director for Blackfinch Group.
Morning, everyone. Thanks for joining.
And for those of you who are new to us this month, we look to follow a usual structure today, which is where we do a quick review of the key events for last month. And I'll pass the baton over to Alex, who's going to give us some colour on key considerations and the outlook for Feb. So as always, please feel free to use the Q&A box at the bottom of your screens, and we'll try to reach out after today's webinar to address them. But on to January. And it really has been an interesting first month to the year. Investors were on all-time highs off the back of the everything and Santa rallies in November and December. Asset prices and indices were reaching new heights, and it really did spark a period of exuberance where investors were flirting with the idea that developed market policymakers would bring forward planned interest rate cuts. However, as we know, those expectations were firmly replanted after mixed economic data came through. And if we start in the US with the Federal Reserve, those 2024 rate cut expectations fell sharply at the back end of January. Chances of a rate cut in March fell from 81% to 47%, and I believe it's come down even further now. And the decline in part was caused by comments made by Fed Governor Christopher Waller, who told a virtual conference that he saw no reason to move as quickly or cut as rapidly as in the past, given the healthy state of the economy. And it does really feed into that higher for longer interest rate scenario that we've seen play out over 2023. However, although we saw the Fed hold interest rates again in January, we're seeing hints that the end is near. And in terms of some of the economic data, very quickly, US December retail sales numbers easily exceeded expectations, which suggests the consumption side of the economy remained in a much more solid condition. We also had another upside surprise in the US jobs market, which confirms the Fed's reluctance to cut rates sooner rather than later. We saw bond yields have a big jump off the back of the Fed's last meeting due to a lot of that strength in the jobs market. Stocks rallied in contrast as investors were buoyed by the prospect of a robust growth in jobs and wages would stoke sales and profits for companies. But all of this kind of isn't the direction of traffic that the Fed would like to see, as it views taming wages as a critical step in wrestling inflation down to its target. And a final point on the US, I'm sure as many of you know, US earnings season's in full swing at the moment, and it really has been a story of the tech sector and Magnificent Seven so far. We had one star of the show, which was Meta. Their earnings have just been stellar, and actually, if you chart the market cap of the company, it has flown upward. The company added nearly $200 billion of value within days of its results being published. And if we compare it against Tesla, although Musk and Zuckerberg didn't have their anticipated cage match, the company certainly did in terms of market cap. Tesla was knocked out of the Magnificent Seven and has been falling in value compared to that kind of stellar Meta performance. But as a whole, earnings for the companies remain strong, and all eyes are on the growth of AI and how this is going to transition into underlying profit. But if we go over the Atlantic to the European Central Bank and look at policymaker rhetoric, again, the ECB's opted to keep its key interest rates unchanged, and it's at record highs still. And they reiterated that monetary policy would stay at sufficiently restrictive levels for as long as necessary to bring down that inflation to its 2% target. But the President, Christine Lagarde, stressed the policy decisions would be guided by economic and financial data and reiterated it's premature to discuss rate cuts. But she did seem to strike more of a dovish tone, noting that the disinflation process was working. But they did say that risks to economic growth remain tilted to the downside, and European markets are still trying to judge when that rate cut's going to come. For the UK, inflation's a key story for January. Again, the annual rate of inflation defied expectations for further easing in December. It ticked higher from 4% from 3.9%. It was the first increase in 10 months. And yes, it did cause a bit of a bump and the road down to 2% inflation, but the general trajectory is still downward and seems achievable this year, or it being range bound at the very least. Other data provide mixed signals for BOE policymakers. Growth in wages slowed to its weakest pace in nearly a year. It rose 6.6% quarter on quarter to this time last year. Retail sales were much weaker than expected in December, fell 3.2%, giving the biggest month-on-month fall since January 2021. And obviously, those shipping disruptions in the Red Sea has caused input prices, particularly in the manufacturing sector, to rise for the first time since April. And it may contribute to a pickup in inflation, but economists are watching to see how it's going to unfold. And finally, China, who has been on the naughty steps of late somewhat. Gross domestic product expanded 5.2% in the fourth quarter, year on year. It met Beijing's official annual growth target, but even though it met the target, it's still one of the slowest levels of growth we've seen from the region for a long period of time. We also saw other bits of data that highlighted pockets of weakness in China's economy. We saw a decline in real estate investment, which deepened concerns further over the sector, as well as Evergrande moving into liquidation, who are China's largest property developer. There are signs of stimulus coming from the government, but this is largely focused on propping up some of the state-owned company valuations rather than focusing on the consumer, who are the ones that need the most attention to get things moving again. But all eyes on the government as we look forward, as they're well aware of the lack of foreign investment as it stands. But I believe that's everything, Alex. So if I pass to you.
Thanks very much, Josh. And yeah, I'm sure your clients are going to be slightly relieved to see the sort of more buoyant valuations in their portfolios and markets, certainly over the last quarter. As Josh has kind of touched on, January was fairly benign for a lot of markets, save for the technology sector in particular. And looking forward into February, we're not really expecting too much action. Touching wood, saying that there. February is a relatively quiet month. Sort of the key dates to watch out for really are mid-month. 13th of Feb, we are looking at the UK unemployment data. We're expecting ever so slightly a tick up to 4% from the previously published 3.9%. Don't forget, the strengths of the jobs market, both here in the US and Eurozone, is really key to driving that longer term inflation number. And it's got a really sort of strong impact in helping to bring that down over time. So that will be a key date around the 13th. Also on the 13th is US inflation. Now, headline inflation, very early estimates are expected to see headline inflation drop slightly to 2.9%. But again, we'll start to see some more expectations come out as we approach the date. But nonetheless, again, markets want to see that general downward trajectory in inflation to support asset prices where they are right now. 14th of Feb, a Valentine's Day treat. That's UK inflation. Again, similar story. We want to see those sort of core components of inflation falling nicely in line with expectations. We don't want to see any material upticks there. And again, that's to maintain the status quo, to help the markets sort of really believe and buy into the fact that we are at peak rates. 15th of February is UK GDP as well. So again, important for domestic investors. We're expecting month on month and quarter on quarter to come in around a big fat zero. So again, flirting with that potential to fall into a technical recession or not. Not really expecting any meaningful prints outside of that at the moment. So that's just one to watch. Certainly the overarching message, though, I would say, and we have said this before, and it does sound like a stuck record to a degree, but the markets really are looking at, when it comes to interest rates, not so much as how high, but for how long. And that's really been the key story since Christmas. And that shift in market expectations are not that we expect to see many more interest rate hikes from this level, particularly UK, US and Eurozone, but there is a slight level of nervousness coming into markets that these rates may be maintained at this sort of elevated or relative elevated level for a bit longer than expected. So we're starting to see some adjustments in expectations there. But yeah, as far as February goes, it does appear quiet on the economic calendar front. So let's hope that we can have a month of slightly lower levels of volatility, because we can assure you the rest of this year, particularly when you look at the political front, is sure to be filled with a lot of surprises and chances for market shocks. So With that, I think that covers everything. Thank you ever so much for joining, and we will see you again next month.